It's Money Monday, and of course, I'm making sure that we have a conversation that is going to convert over to some cash. So go ahead, open up your spiritual purse, open up your actual purse, open up your bank account. I don't care if you got your stimulus check or not. Just open it up because I'm going to give you some money, honey. You ready? You ready? You ready? You're ready, 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 you're ready. That's exactly how I want money to flow to you easily and effortlessly. And I hope that you gain something from this show that will help you in how to allocate it in a way that you grow more of it, in a way that doesn't feel so stressful, sis. Okay, so this week, what we're going to be talking about is life insurance, right? And a lot of people don't really like talking about death. And I get it, I totally get it. But here are some thoughts and ideas that I have, right? Some thoughts and ideas. I think that everybody should at least have $1 million in life insurance. I really do. I really do. I believe that everyone should have a minimum of $1 million in life insurance, because that way we know for sure that every time someone leaves, they leave and a Black millionaire is born. I really like the thought of it. Life insurance is something that you should be getting when you're much younger, because the older that you become, the more expensive it becomes, and the probability of you definitely, not being as healthy as you are right now, right? But I want to talk about life insurance in a way that you really understand it, because what I find is when I'm working with my clients and I talk to them and I say, do you have life insurance? Sometimes they say, yes, I have it through my employer. And I say, well, exactly how much life insurance do you have? Sometimes they have to look it up. They have to go and find it. And I ask them questions like, hey, do you know what kind of policy it is that you actually have? Do you know if this is term? Do you know if it's whole? Can you borrow money from it? And sometimes they're just looking at me like this, right? And anytime that you're paying for something, you definitely should know what performance it is providing to you. You should really, really know that. So I have one of my boss bays that is actually a State Farm agent, and we are going to talk about life insurance today in a way that I hope that it makes you think about it. Now, there are some statistics out there that if you don't have life insurance and you really don't know what it is, there is a high amount of people that is using crowdfunding. That's right. Lots of people use crowdfunding in order to bury their families, right? And for me, that is just so overwhelming. Can you imagine what it is like to, one, be burying one of your loved ones, and then on the side of it, having to raise funds in order to bury them? I just find that to do a lot of, just what we call a lot of insult to injury. I don't want anyone to experience that. That's one of the reasons why I definitely want to talk about it. And I also want to talk about life insurance in a way of it being a part of a wealth building tool for you. Okay. All right. So I'm not having this conversation by myself. I'm actually having it with one of my boss bays. She is a State Farm agent, and she has been doing this work for over a decade. She's had her agency for the last 6 years, but this is a conversation that she and I has on a regular, because we think that it's really, really important. So for those of you who are taking notes and you have a policy, but you don't really know how it performs, you have a policy and you're paying for it, but you really don't know what it really does for you, we hope that you are able to gain some value from the conversation that we're going to have tonight. Let's welcome Natalie on. Hey, Nat! Where are you?
Can you hear me?
There you go. Hey. Hey.
Hey.
All right. Did you grab some of that money, honey? Did you grab some of that money, honey? Did you grab some of that money? That's good. That's good. That's good. That is the hope. That is the hope. Okay, so we're going to have the conversation, and we're just going to talk about life insurance as a wealth building tool, ways that people can have life insurance that will help them, earn money, use it for some other things. And then we want to talk about just life insurance, just making sure if you don't have it, that you get some, and make sure that you know how to ask the right questions to make sure that if you have life insurance, it's actually going to do what it is that, that you want it to do, because there are so many instances where people have policies and those policies really don't perform in the way. I see your face, right? Yes, I've seen so many different scenarios that are just, just overwhelming. And just to think about dealing with paying for life insurance for years, and then when it's time for you to take advantage of it, that it's not there. It's just a little overwhelming. So let's talk about life insurance as a wealth building tool. Let's start with the children first. Let's do children first, right? Because if the children are well, the community is well, right? Okay, so you have a favorite way that you like to see people buy life insurance for their children. Tell me about that way.
Well, actually today I just had a grandmother purchase a life policy for her granddaughter. And of course, is a stigma. People don't want to buy life insurance on their kids because they feel like, oh, okay, I don't want my kids to die before me. But the reality is what we did today is we helped her set up a college fund for her granddaughter, which essentially she will pay for in 10 years. Okay. And by the time that child is 10 years old, it will be paid off, but the money will continue to accumulate and grow, as well as the death benefit. So by the time she's 18, there's going to be a certain amount of money in the cash value that the granddaughter can access to pay for college. Okay. But here's the other awesome thing is that the cash value does not have to go in a FAFSA form, okay, that you fill out when the government asks you what assets or income do you have to go towards paying for college. Cash value in a life insurance policy does not count because it is a life insurance policy, not an investment. And the good thing too is if this granddaughter of hers gets scholarships and doesn't have to use the money for college, then that money could be used for something else, like purchasing her condo, or purchasing a home or purchasing a car. It could be used for whatever the granddaughter wants.
That was a lot of strategy right there, right? So let me just unload that one because that one was really, really good. That was loaded, okay? So you talked about, hey, Casey, hey, Nicole, thank you guys. Be sure to share. So what it is that you just shared, Natalie, was really loaded. It was a full-fledged life tool, okay? So the first thing is that the woman's going to be finished paying for it in 10 years.
Yep, 10
okay?
years.
So 10 years, she's done, okay?
Yep. This is grandma.
All right.
This is grandma.
Grandma's finished, right? She's finished, okay? Not only will she be finished paying, this is not something she's going to be paying for after 10 years, right?
Nope.
She's allowing this to possibly be available for her daughter to use towards going to college because there is some cash value that she can tap into for college, okay?
Yep.
The beauty of it is that if she needs to apply for any student loans, this is not going to be reported on her FAFSA as her savings, right? Because it is inside of a life insurance policy, okay?
Yes.
So for those of you who are taking notes, that would be your first note to notate, okay? To look into a life insurance policy that will allow you to pay it off in a certain amount of time. It is specifically for your children and can be used as some of the funds can be used to go towards college. The reason why I did that some is because I'm thinking that the cost of college is going to go up. So depending on the amount that cash value is, it might help, I don't know if it's going to take care of it. But I do like the fact that the benefit of it is that it doesn't have to go in your FAFSA. Okay.
Yep.
So that was super, 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 super. Okay. So, aside from once that is a way to take care of the children, make sure that they have it. Now, some downsides, what would you say some downsides to that type of policy would be, Natalie? What would be some downsides?
And I'm not just saying that because I'm not, how should I say this? What I'm about to say is I don't really see a downside to purchasing life insurance on a child, because the other point I wanted to make is that you're guaranteeing this person's insurability. Okay. You said something earlier in our conversation that you never know what's going to happen, if you're going to be able to qualify, how your health's going to turn out. And, right now she's already locking in, for example, $250,000 of life insurance for her granddaughter. Also, her son is actually the beneficiary of the policy. So this is a policy that could keep going and keep going. And then when that granddaughter then has children, she becomes the owner of that policy, and then she can make her children a beneficiary. So I really don't see a downside of actually purchasing a life policy on a child.
Okay, got it. We have a question from the audience. Casey wants to know, what is the specific name for that policy?
So I'm a State Farm agent, and the product is called a 10 pay whole. It's a whole life limited 10 pay. And we also have, it's just basically a whole life, but you pay it off in 10 years. And you also have one that's called a 15 pay and a 20 pay. So basically, it just means whole life.
Ooh, we lost your sound. Okay, you're back. Okay, so Casey, the name of that, she's a State Farm agent, but yeah, okay, so she's back. That is a whole life policy, 10 pay, 20 pay, 15-year pay is just going to specify the amount of years that you're going to be paying for. So you can pay for it sooner or you can pay for it later. Okay.
Yep.
That was great. All right, so we're moving on. Now, there are some other things that cash value can be used for. And what are some other things now that we've taken care of the children? What about the adults? How do you like to see adults use their life insurance policy?
So we talked about overfunding a life policy, right?
Mm-hmm.
One of the cases I'm actually working on is for a pastor, and sometimes people don't realize that pastors or even business owners, they're self-employed, so they may not have a 403b or 401k like as if they work for a corporation. And so basically they're essentially setting up their own retirement. And the plan that we're putting in place, even though he's starting a little later, he's about 50 years old, and he says he wants to retire at age 70. And we said to him, okay, well, at age 70, what kind of income do you want? He said, well, I'm going to pull out about $12,000 a month, roughly $140,000 a year. So how we're setting up this policy is that for 20 years, because he wants to start pulling out money at 70, for 15 years, for 20 years, he'll be funding the policy about $97,000, okay, per year. And at age 70, he's done paying, and then he's going to be able to pull out $140,000 roughly for the next 15 years. Now, people would say, well, does that make sense? How is that different than other retirement vehicles? How is this different is because the growth of the money in a life policy is going to be tax-free. When you take that money out as a form of a loan or withdrawal, you won't be paying taxes on it, unlike the other vehicles like 401ks, 403bs, or any other pre-tax vehicles, because you're funding this with after-tax dollars. So that's a way that people use, that we call like a rich man's Roth, way people use life insurance for retirement. And just generally speaking, maybe you don't want to just do this for retirement. You just want to have a bucket that you're putting away, or you characterizing for tax-free dollars. Now, with the current economy, we already know that taxes are going to do what? Nothing but go up. So we don't know what taxes are going to be when we start to pull out money from our, retirement vehicles. So say you just want to have a bucket where you want to stash some cash that eventually, when you do pull it out, it's going to be tax-free. The growth of that money is tax-free plus your principal.
Okay, so for those of you that are tuning in, we're talking about how to use life insurance as a wealth building tool, and there are a few business people that actually use life insurance to fund their businesses, and the list is very wild. One of them is Walt Disney. That is one of the ways that he funded, as well as J.C. Penney. That's how they kind of put their money to the side and allowed it to grow. One thing for sure that you can look at taxation right now, especially looking at the economy in this particular moment, you're guaranteed to know that taxes are going up because they're so low. And what's going on with all of this money that's being shelled out, that money has to be accommodated for. They got to get that money back, and the way to get that money back is through taxation. So if your money is tied to just regular savings, you know that you're going to be paying highly when it comes to taxes. So that's another thought. So now there is this thought in this theory that's out where, and I used to sleep in this house a little bit. I kind of used to like this approach to life insurance for a period of time, but over time I just kind of saw with people's habits, and I'll talk about it. It's buy term and invest the difference. Buy term and invest the difference. I see your face. I see your face. So because I see your face, I want you to tell me how you feel about this whole ideology of buy term and invest the difference, and I'll share my perspective.
Okay, so before I answer that question, I do want to go back to our previous topic.
Sure.
If you go to, most people don't realize that another large investor in life insurance is actually banks. Okay.
Oh yeah.
Banks have more permanent life insurance than they have real estate. So you think about it. If you go to Bank of America's, balance sheet, or Wells Fargo, look at how much permanent life insurance they have. And if banks are investing in it, you probably should too. Now, let me touch on this question about the buy term, invest the difference. Let me be honest with you. I have over $3 million worth of life insurance, and I am unmarried. I don't have children. Some of it is term and some of it is perm. But the reality is, most people that I've seen who had that notion, buy term and invest the difference, they never invest.
Okay? That's what I'm saying. Put me on the screen. That's my problem with it, right? So I like the whole ideology of buy term and invest the difference. I also have a mixture. I have some whole and I have some term. Term being the higher amounts, right? Term is where my higher amounts are. However, this ideology of buy term and invest the difference, what I'm seeing now is people not investing that difference
because they don't have the discipline. And I'll tell you, for those that I've even we've done just whole life, okay, or permanent insurance, or we've done a mixture, that money and the permanent policy has accumulated, and they don't even know how much money it is because they're not checking it as often, like a bank account or something where they have immediate access to. So I'm not saying term is bad. Term has its use. It's for temporary needs, but I am definitely a proponent of at least having a mixture of, or having some permanent. So when that term runs out, or you don't have that temporary need, you still have this long-term need for life insurance. You got your life insurance policy that's still there when you need it, because you are going to die one day, and you also have some cash value that you can access for whatever at any time that you wish.
All right, so for those of you that are tuned in, I want to give you a few tasks that I want you to complete. Number one, I want you to ask yourself, are you falling within that 1 in 4? 1 in 4, and I'm going to flash some statistics right there so you guys can see it. Ask yourself if you're falling within that 1 in 4, right? If you're falling within that 1 in 4 people surveyed saying that they bought life insurance the first time during coronavirus. They didn't have any before. So if you're falling within that statistic, that 1 in 4, me, you being the 4, I want you to ask some questions about getting yourself some life insurance. That's the first thing that I want you to do. The second thing is, if you already have life insurance, I want you to make sure that you know what type of policy you have. Do you have a term policy, or do you have a whole policy? I want you to know that by the time you get off this live tonight. I also want you to know how much life insurance do I have? How much? How much do I have? Do I have $1 million? Do I have, 250? How much do I actually have? The other question is, I want you to ask yourself, is my life insurance tied to my employment? Is it tied to my employment? If I'm leaving, am I leaving my life insurance? I want you to ask yourself that. Those are some base level questions that I want you to ask yourself tonight. And then ask yourself why. Why don't you have life insurance? Why don't you have life insurance? Okay. So those are some simple things that I want you guys to do. We did get a question asking the difference between term and whole life and universal. So if you want to kind of break down term, whole, universal, because there's so many different policy options out there, let's make it easy for our audience to know what they have if they have it.
So generally speaking, you got term insurance and you got permanent, which is going to be either universal or whole life. So let's just talk about term insurance. I liken it to like renting insurance. Okay. There is no cash value. There is no living benefit, but the life insurance company promise you that if you die within a certain period of time, the term being 10, 20, or 30 years, they're going to pay out whatever that death benefit is. But if you outlive that term, then you get none of that money back. And the chances are you probably are going to outlive that term, because the statistics say that only 2% of the time that the policy pays out. So for every 100 term policies, only 2 actually pay out. Most people outlive the term or they cancel it beforehand. I'll even tell you State Farm in between term and permanent has what you call a return of premium, which I'm not sure what everybody else has, but State Farm has it. I liken it to like living with your grandma, because when you move out your grandmother's house, she's going to give you all your money back. It's basically a term policy, 10, 20, or 30 years, that if you outlive the term, State Farm will give you back all of your premium dollars, dollar for dollar. So if after 20 years you pay $15,000 in premium, and State Farm is going to give you that money back if you outlive the term. So it's a huge win. Now, permanent insurance, that's where your whole life and your universal life to me falls under. I liken that to buying a house, because that's where you have that living benefit. They both have cash value. Whole life basically is like whole life. You can pay it for your whole life. If it's $20 a month, over, that's what the contract is, and you're going to pay $20 for the rest of your life. But then you have variations of whole life that I mentioned earlier, your 10, 15, and 20 pays. Those are whole life policies, but you only pay them for a certain amount of time. That's what you call your limited pay whole life. Then you have your universal life policies, which is similar to whole life, but basically it's a term policy within a whole life policy. The good thing that I like about the universal life policy that's different than the whole life, that it has flexible premiums. So if, for example, right now interest rates are super low, right? But our universal life policy right now is paying a minimum of 2% interest and upwards of 2.25. You can actually take money out of your bank account, or that's not paying enough interest, and do what you call a UL dump. So you can actually put money into that cash value to earn, for example, 2% of what our universal life policies are paying.
Okay, so let me open that up just a little bit, because that one was a nice one. So here's what you're saying here is that particular policy that you're talking about right now, it's paying about 2.5, which is definitely going to be more. 2.5 upper, okay?
Yeah.
Definitely going to be more than what you're going to be getting at your bank. If you go and look at your savings account right now, you're going to see that 0.14%. If you look at your CD, you're going to see maybe that 0.27%, okay? If you look at your money market, maybe, I
Not
don't know,
even 1%.
Right? Those are just going to be some base products. So what she's saying is that the particular product that she's talking about actually has the opportunity. If you have money in your regular savings, you can take that money from your regular savings and put it into that life insurance policy. That way that it's actually earning that particular interest rate. And the flexibility is that, hey, you know what, I'm at a different level right now. I can go ahead and stop saving. I don't have to put these additional savings in because it's up under your control, which is a little bit different than the payment. So that was really, really good, Natalie. We gave some good things. So I'm going to go ahead.
I got one more thing. One more tip.
One more tip,
right? Because I'm an insurance agent, so I'm always talking about risk. But another thing that people don't realize is that your cash value in your life insurance is protected. It's protected from lawsuits. It's protected from predators, creditors. So because it's not an investment, it's not a bank account, it's a contract. It's a life insurance contract between you and the life company. So that's another layer of why people will want to, for example, move money from a bank account to a policy, because your money's going to be protected.
Right. And there's always that point of incremental savings, right? So depending on where I was in my finances, I would go ahead and up level. So I make more money, I got more life insurance. Make more money, get more life insurance. If you want to go ahead and this is for people that are not into investing. Like if you haven't started taking advantage of Bitcoin, if you haven't started investing in the market, if you don't understand anything about trading stocks and things like this, a lot of the times I'll tell my clients, this is a great place to just let your money sit while you learn. Because if you're letting it just sit in your regular savings account, it's not keeping pace with those two things, taxes and inflation. Okay, sis?
Yeah.
Okay.
Yes.
All righty. So we gave you guys a lot of information as it relates to life insurance. If you don't have any life insurance, that's the first thing that I wanted to put on your mind and your money tonight. To number one, start letting this conversation be the beginning to making sure that you have some form of life insurance. Ask yourself simply, and I actually pulled up a little bit of note for you. Natasha, go ahead and show that note just so that we can look at the cost of life insurance, just so you guys can look at the cost of it. Can you add money to the universal policy throughout the life of the policy or just at the initial enrollment? That's a question for Casey. You can keep doing it. All right, so here is just a simple little stat I want to show you guys, right? If you're at the age of 30, if you're female, 193, this is going to be the annual rate. This is about $193. 40, at age 40, you're spending $289, 50, $654. So if you receive that stimulus check, sis, and you don't know what to do with it, okay? Here is one of the things that you can definitely do with it. You can make sure that you can definitely get yourself some life insurance that may not be attached to your employer, because if you leave your employer by way of entrepreneurship or by way of termination for anywhere, for any reason, then you'll find yourself without some life insurance. So we want to make sure that you have those options available to you. As always, I hope that we were able to put at least one thing in your purse that added some value to it. What kind of policy should you use as a savings? And that's going to be our last question before we head over to IG. What kind of policy should you use as your savings? What would you say on that? It really depends. I'll start with that, and then you can get into it. So interesting enough, like in terms of just savings, it really depends, right? Like, is this your 6 to 9 months? Because if this is your 6 to 9 month savings, then you are just going to put that in a regular savings account. You don't want to tie that to anything where there's going to be any penalties attached to it. You don't want to have to ask somebody for the money and then they go, oh, well, you know, you got to get it as a loan. You don't want that. You don't want to go and say, oh, well, we're going to decrease the amount that you available to. Let's put those 6 to 9 months to the side. Just go ahead and put it. Once you get to the 6 to 9 months, then you can say, hey, you know, I want to put some more of this money towards my life insurance. It doesn't mean that before you hit that 6 to 9 months that you should live without life insurance, because I just showed you the pricing. $284, sis. $684 for the year. So you know that's costing you about $22 to $32 for the month. This is what we're looking at. 30, your 40s, your 50s. 193, 289, 654. And this is on a 20-year term life at age, okay? Okay, sis, so we're gonna head over to IG. So if you want more of this conversation, you can meet us there. Until next time, do something that's gonna add some value to your purse. I'm Shani, and that's